Ladies and gentlemen, good day and welcome to Nippon Life India Asset Management Limited Q3 FY22 earnings conference call hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Bhise from JM Financial. Thank you and over to you, sir.
Thank you, Nirav. Good evening, everyone, and thank you for joining this call today. From Nippon Life India Asset Management, we have the entire management team led by Mr. Sandeep Sikka. Without wasting time, I would want to hand over the call to Mr. Sikka. Over to you, sir.
Thanks. Good evening, everyone, and welcome to our Q3 FY22 earnings call conference. We have with us our Chief Financial Officer, Prateek Jain, Chief Business Officer, Saugata Chatterjee, Chief Business Officer, Ashwin Dugal, Chief Digital Officer, Arpan Saha, Head of Elite Partner Client Group, Nitin Gupta, and Fujikake-san, nominee from Nippon Life Insurance, Tokyo. Overall industry assets grew at an even pace in the quarter, driven by rise in equity and passive segments, while fixed income saw muted growth. Despite high equity market volatility, industry's steady performance was a result of continued interest by retail and HNI segments. The industry's unique investor grew by 15% in Q3 and crossed the 30 million mark. The strong growth in the investor base and the overall assets indicate confidence in long-term investors in mutual funds. We expect the industry to maintain its growth momentum in future also. At Nippon India Mutual Fund, our priority is to be future ready and capture the long-term opportunity. As stated earlier, we are confident of regaining our market positioning as well as recreating and reinventing by continuously innovating and disrupting ourselves. Towards these goals, I am happy to share our overall market share rose by 22 basis points in the last 9 months to 7.34%. AUM increased by 32% to rupees 2,806 billion. This is the third sequential quarter of market share gains along with the improvement in other qualitative parameters. We increased our share of industry unique investors to 33% with a base of 10 million investors. Also, our share of industry's B30 folios grew from 10.4% as on December 2020 to 11.6% as on December 2021. The growth was driven by improved fund performance, comprehensive product portfolio, enviable track record in passive segment, and robust risk management and granular distribution network. In line with our investor-first philosophy, we keep expanding our product suite to cater to the investors' varied needs and diversified demands. In Q3, we launched India's first fund focused on dynamic and growth opportunities in Taiwanese market. The Taiwan Equity Fund raised 65,000 applications, including 6,000 HNIs and family offices. In Jan 22, we completed the NFO of India's first auto ETF and silver ETF and silver ETF fund of fund. Other such unique offerings in the pipeline include S&P EV Index Fund, the Innovation Fund, and Artificial Intelligence Fund of Fund. In total, we have filed 11 schemes for regulatory approvals. These products will provide investors with more value-creative avenues to diversify risk and generate sustainable returns. Here, I would like to reiterate that even in future, we will focus on strong asset growth, but never at the expense of profitability. Driven by keen retail focus, we have one of the largest retail AUMs in the industry at rupees 776 billion. The contribution of retail AUM to total AUM is amongst the highest in the industry at 28% compared to 23% for the industry. We are amongst the market leaders in beyond 30 cities category. This category contributes an AUM of rupees 488 billion. 18% of the total assets are sourced from these locations against the industry average of 17%. As on December 31st, 2021, 70% of the individual assets have a vintage of more than 12 months. The annualized SIP transaction book is at rupees 82 billion. On a gross basis, the systematic folios rose by 385,000 in Q3. Our systematic AUM rose by 38% to rupees 507 billion. 45% of our SIP's AUM has contributed. 45% of our SIP AUM has continued for more than 5 years, vis-a-vis 20% for the industry. Also in the volatile markets, folios with low ticket size have demonstrated longer vintage and better stickiness. 12% of our SIP folios have continued for more than 5 years as against an industry average of 8. Today, Nippon India Mutual Fund offers the industry's best suits in passive products. The strong growth in industry's passive assets, our ETF ecosystem is already in a place and far ahead of the peers in terms of investor base and mind share. In this segment, we manage AUM of rupees 515 billion and have a market share of 13%. Excluding the EPFO allocation which goes to 2 public sector mutual funds, we are the largest ETF player in the country. Our gold ETF is the biggest fund in the category with having assets in excess of rupees 63 billion. Nippon India's share in industry ETF folio rose to 60%. In Q3, we added 1.6 million investors and accounted for 70% of the total ETF folio additions in the industry during this quarter. And Nippon India Mutual Fund has 69% share of ETF volumes on both NSE and BSE. Our ETF's average daily volume across key funds are far higher than the rest of the industry. As a well-diversified asset management company, we have begun to grow our non-mutual fund segments over years. Along with the government mandates, we manage assets of rupees 677 billion in non-mutual fund segment. The offshore business has assets of rupees 115 billion under management and advisory. Leveraging Nippon Life's global network, we continue to ramp up our international presence. As mentioned earlier, Taiwan Equity Fund and other products are in Taiwan Equity Fund and other products which are in approval stage are a step in that direction. In our AIF business, we manage Cat 2 and Cat 3 AIFs across asset classes. As on December 21, Nippon India AIF has raised commitments of 42 billion across all funds. We have received IFSCA approval to carry out asset management operations in our GIFT City branch. By expanding our reach to unique locations, we expect to accelerate global allocation into India and add value to international investors and partners. Online and digital assets have become a strong source of investor acquisition and communication. A strong digital acquisition and engagement framework with targeted performance-oriented campaigns is driven through cutting-edge tools like Adobe Campaign Management. These initiatives have helped fuel consistent growth on our own storefront and various other conclaves. The focus is towards creating a digital experience that is friendly, futuristic, and frictionless for all our partners and investors. In Q3, digital platform contributed 58% of our total new purchase transactions. Over 750,000 purchases were executed through digital assets, an increase of 83%. Nippon India Mutual Fund has a well-diversified and a nimble distribution base. As on December 2021, we have approximately 83,800 distributors on panel with us. The MFD base rose by over 8,500 with an addition of 1,800 distributors during this quarter. Also, we have ongoing tie-ups with 20 prominent digital partners. Direct channel contributes 55% of the mutual fund AUM. On the distributed assets, share of NFTs was 58%. 88% of the distributed assets are contributed by individual investors. Nippon India Mutual Fund has a wide presence across 270 locations across the country. We continue to review our existing branch operations and future expansion plans. In recent quarters, our marketing efforts have increasingly focused on digital channels, which are more cost-effective as against offline advertising. Now on our financial performance. For the quarter ended December 31st, 2021, profit after tax was rupees 1.7 billion. Operating profit increased by 48% to 2.1 billion. Operating profit as a ratio of average assets under management rose from 26 basis points in Q3 to 29 basis points in Q3 FY22. Our aim is to create sustainable value through growth across asset classes, cost optimization initiatives, resulting in expanding and favorable operating leverage. We continue to grow organically through our physical and online channels. Additionally, we remain open to evaluate investment in strategic opportunities that add to the profitability or complement our existing businesses. As a signatory to UNPRI, world's largest voluntary sustainability initiative, we aim to create sustainable future for our stakeholders by integrating ESG principles into our business operations, investment processes, and stewardship. By introducing formal policies including case of fund management, we intend to share a strong and a clear message about the organization's purpose with our stakeholders. Also, as stewards of our investors' capital, we continuously engage and evaluate all our invested companies on their performance on issues related to sustainability, governance, and value creation for diverse stakeholders. To sum up, I would like to reiterate, at NAM India, investor centricity remains the key theme. We strive to deliver a complete product suite customized to investor needs, superior fund performance, efficient client servicing based on comprehensive digital ecosystem. We are confident to continue our trend of profitable growth in coming quarters. With these comments, we are happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question, you may press star and 1. The first question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, good evening, sir. There are 3 questions from my side. Firstly, if I look at your sequential AUM mix, there is a marginal improvement on the equity share, but the yields have dropped. If I divide the revenue by the overall. So what is the reason for that, and could you give some understanding as to how the yields for the overall business could move going ahead? That would be my first question. Second, is a sharp fall in your other income. What is the reason for that, and what could be a sustainable long-term run rate for that? And lastly, on the other expenses bit as well, there has been a decent decline on other expenses. Whether this is sustainable run rate.
So I'll request Prateek to take your 3 questions, please.
Yeah, hi Prayesh. So in terms of the yields, what we've seen is that if you look at our average AUM compared to the last year, what has happened is that our average AUM is about 43% up. So obviously one, because of the size issue, if you see, most of this has been because of the mark-to-market impact. So the size issue, the TR goes down. That is one. 2, there has been an increased competition and the NFOs, which has also has pushed us to relook at some of the distribution tie-ups. So large, and the third part is that the change in the old assets getting replaced by the new assets. So these are the 3 key reasons wherein we have seen marginal decline in our equity realization. And the reason is that, look, if you see in the last 2 quarters, there has been slew of NFOs, and each one of them, and especially from the new players or rather the smaller players, which has gone and given very high kind of a distribution commission, which has sort of created some kind of I would say a tilt towards the or rather people focusing more on the business growth rather than the profitability. However, we remain focused. We continue to focus on profitability, but on a tactical basis, we'll keep reviewing the tie-ups, and while we'll keep growing the business, but our focus will remain on profitability. So that's on the yield part of it. On the other income side, you would recollect that last quarter and earlier also we had mentioned that we have pared down our total exposure to equities, but yet we have almost 10% of our total asset under management or rather the net worth into equities. So of the total assets what we have, or the total cash we have, 90% of that is in our own mutual fund and fixed deposits. Of that, 10% is in equities. So, prior quarter saw almost 10 to 12% increase. This quarter was actually a decline by 2%. So those mark-to-market impact, have led to the difference in the other income. There is no one time or there is no, I would say, any aberration. This is all mark-to-market, and that happens, on the last date of the month. Even if you see on the fixed income side, there has been some yield elevation on the fag end of the quarter, which has also, got mark-to-market. And for that reason, our other income is, down as compared to the previous quarter. Coming to your other expenses part, we have always been maintaining that, look, close to about 45 to 50 odd crores would be a run rate spend, and, we will be, there are expense which are more towards, discretionary part in terms of marketing and digital spend, which we keep, monitoring, and, depending on the activity levels, those are, semi-variable. So you will see, this expense remains range bound, and there is, again, no one-off kind of expenses. There is just one thing that, the transitionary expenses which we were incurring because moving out of the old architecture environment from the previous parents have now completed, and therefore, some of the duplicacy of the expenses have come down.
Okay, thanks for that. Just on the yield part again, while you mentioned that the three reasons for the fall in yield, out of which I think the NFOs continue to be very, price aggressively, or, distribution commissions are given aggressively out there. The TER movement with regards to size, if the equity market, come back to the growth trajectory, will continue to be. And so in a way, directionally, equity yields will continue to drop. Plus, over and above that, your ETFs, share of ETFs will move higher. So in that sense, is it fair to assume that the yields which are, will continue to decline from here as well in the next couple of years?
Yeah, see, if you see again, from our perspective, if the assets, have grow almost like 45-50%, then again, because of the size issue, because of the regulatory size issue, you will see some compression happening. And so, to that effect, there will be a compression you will likely to see, but that will be offset by the absolute growth in terms of the overall fees.
Okay, got that. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Mohit Surana from CLSA India. Please go ahead.
Good evening, sir. Sir, my first question is a continuation of previous question. You obviously said that, as the size of AUMs grow, there will be some kind of a yield compression because of regulatory rules around that. But in terms of NFOs, do you expect the current situation of pricing, distributor commission very generously, do you think that will have an impact in FY23-24 as well, or do you see this as a transitionary kind of an impact? That's my first question.
I think Sandeep this side. I think the way I see it, this is a transitionary thing. I think we have seen, some AMCs trying to filling up their portfolio by launching new schemes, because there's also a constraint on how many. Now you cannot launch multiple schemes. SEBI already has one scheme per category, and you have seen some new AMCs coming into play. So I think this is transitionary. I think I take it more, from a long-term point of view. I'm seeing more focus on profitability in this industry than ever before. So I think by personal view, this is a transitionary thing and will settle down very soon. And even if, this industry is all about volume, I think a drop in 1 basis point yield, 1 or 2 basis points can happen, never be ruled out. But I think more than that can be compensated by increase in volume. I think, and from our perspective, what we continue to focus on, increasing volumes by getting better quality assets. And as I mentioned in my opening comments, the stickiness of the assets, smaller ticket size, I think all these things are going to play an important role, because markets will remain volatile. I think so that as we play through the different market cycles, the stickiness of the assets is going to be more important than just the AUM. And I think our focus remains on that.
Got it. And so the second question is around ETFs and index fund. Obviously, you have a lot of index funds in pipeline. So I just wanted to understand in terms of your contribution to bottom line, how should we look at it in terms of your strategic plan to grow into ETFs and passives? How should it incrementally contribute to the bottom line?
So I think from our perspective, I think I'll just give you a directional view how we see, and then Prateek will answer about the P&L aspect. I think from our perspective, I think we have always believed our philosophy is investor first. I think we clearly believe whatever is good for the investor is good and is good for the AMC and the entire ecosystem, and we need to keep offering. I think we have clearly seen there has been a shift towards the ETFs and index, and I think we've been, we were able to catch if you were to go to slide number 18 of our presentation, that will tell you our position, where we stand, where we are almost 70 to 80% of the volumes of the stock exchange. And unlike mutual funds, where normally investors like to diversify into 4 or 5 different schemes, in ETF there is no need for an investor to diversify into multiple ETFs, because I think the underline is the same. So I think there is going to be a first mover advantage that we have and we will enjoy. From our point of view, I think we broadly net, I think we are having the realization of about 9 to 10 basis points. And I think on a total, our today ETF books, total book is about on maybe 50,000 crores. 50,000 crores. So accordingly, about 50 crores is really contributed to the bottom line because of that.
Okay. So are there no additional expenses related to ETFs and index funds?
So I think from our perspective, broadly, I think the ecosystem that we built up, I think today, any new launch does not, I think, lead to any incremental cost for us. It's negligible, nothing worth talking.
Sure. Thanks a lot for your response.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Amit Nanavati from Nomura. Please go ahead.
Yeah, hi. Question on OPEX again. Basically, if I look at just the quarterly run rate of non-employee, non-brokerage kind of expense, purely overheads, we've been clocking around 50 to 53 crores odd. This is roughly 10% lower than last year, and if I look at pre-COVID run rate, this used to be around 70 crores, right? So it's a decent improvement that we've seen here, in addition to cost rationalization on the employee cost as well. But if you can just qualitatively, indicate towards which segments or what heads are seeing rationalization in cost, and how can this trajectory be maintained, or these are like one-off cuts and which more or less has kind of bottomed out?
No, so Amit, if you recollect, almost 12 quarters back, we had a lot of questions around our higher OPEXs compared to some of our industry peers. And thereabout, we started deeply looking into, all of each individual line item expenses. And, if you recall, 2 quarters back, I mentioned that, look, we have now reached to a steady state with 10% plus and minus, because most of these costs are broadly fixed in nature. Some of them are semi-variable and some are discretionary. So large part of this cost of that 50 crore what we talk about, almost 70% is broadly considered as a fixed and semi-variable, where these costs will continue. There is still some discretionary cost which we have, which we basis the transaction volume, basis the activities. Those expenses keep moving up or down. And also, again, as mentioned, to be future ready, we keep engaging into expenses related to either digital or marketing. So these are some discretionary spend which we'll keep depending on the market environment, depending on if we come out with a new fund offering, etc. Obviously, there will be some elevated spend towards that. So that discretionary element will remain. But barring that, if you see, these expenses by far will remain in range bound in around these numbers. and which, if you look at the last 8 quarters, this has been around this and these numbers only.
Yeah. So basically, would it be largely marketing spend cuts that we would have done? Rent may not go down as sharply. Other heads would be smaller, right? So it's largely marketing and advertisement where we would have seen large cuts, or it will be some other segment?
No, so it was, if you see from the past, it was across, we had a lot of these service providers which we have gone and renegotiated costs with them. Some of them we have changed, and some of the other establishment costs which we were incurring, we have actually gone to, like take the example of our own head office. We have now moved to, a smaller location. So, and then we have got consolidated everything, our IT under one umbrella under IBM. So we have done quite a bit in terms of rationalization of our third-party spend on the spend which were related to, of course, travel, conveyance, and others have also come down because of the COVID, of course. And in terms of marketing also, earlier we used to spend more on the offline media. Now the online media is comparatively cheaper. So, it's a slew of changes, not just marketing, it is across board. We have, looked at each and every spend, and that we started almost 12 quarters back. And in the last 5 or 6 quarters, we have been into some kind of a steady state expenses. You will see plus minus 10% in the quarter on quarter. This was due to the discretionary spends.
Got it. Secondly, on the AUM side, right, one larger drag on the yield also is because your upfront plus trail AUM kind of getting replaced by a full trail model as well, right? Where are we in that process? It's already 2-3 years now, right, since the regulations changed. So would it be fair to assume large part of the AUM which needs to get replaced is by and large replaced? Obviously, there will be some sticky AUM which will take longer to get replaced, but by and large?
Yeah, so if you see, unfortunately for us, for a large part of the last 2-3 years post the regulatory changes, we have seen, quite a fund outflow, which has happened earlier because of our transition issues and later on because of the performance issue. But now with the performance coming back and the top 10 of our schemes now under the, quartile 1, I think we believe that this outflows is more or less over, and this asset getting replaced. Also, there is a fatigue factor coming in from a outflow, because most of the money which was to go out has already gone out. So if you see our market share stabilizing now in here, and with the improved performance, we're likely to see more inflow coming in, and so the asset replacement which is causing this drag, which is not likely to be there, but yes, the asset replacement drag may not be there, but the new asset which is only the trail, definitely that will keep putting pressure on the yields.
Yeah, which is fine. At least it.
But that will be only on the new incremental one as compared to the yield. The amount which gets outflow, it has a much larger impact because that was upfront plus trail, and the new one which is coming is only on trail.
Got it. Lastly, if you can just quantify the yield in the equity segment that you are making now.
So we do not give specific yields asset-wise, but it's been it has declined over the last few quarters, and as I mentioned to you broadly because of the 3 reasons. One, the increase in size, from 80,000 if you see for the last quarter, comparative quarter to 120,000. So that has been one. Second, of course, replacement of the old assets, and third, of course, because of the the current new environment where a fund is coming largely through the new NFOs, etc., where competition has been getting very high distribution cost. So all 3 reasons have played out, and we have seen some compression on our equity yields.
Thank you. Sorry to interrupt you, Amit. I'll request you to come back in the question queue for a follow-up question. I request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi, good evening. So my first question was around our equity market share loss, which has still persisted even in Q3. So if you could highlight, what is causing this loss? Is it performance or is it flows? What is the problem we are facing? And the second one was around if you could quantify the NFO expense line item for Q3 and maybe Q2 to understand such a sharp decline in such a sharp improvement in our other expenses. And third was around, if you could explain us, what is the concentration of your IFA sourcing to your equity AUM to understand what are these new IFAs bringing to the table in terms of AUM or the flows. Yeah, those would be my questions.
I'll take the Sandeep. I'll take the first question on the equity market share. I think our overall market share has stabilized, and as you can see in the last 3 quarters, overall AMC market share has gone up by 22 basis points. Equity still continues. There's been a little minor dip. I think one of the reasons for that, while we have started seeing new flows coming in, a lot of flows which are coming in the industry are also a function of the SIPs which were started in the last 2-3 years. The last 2-3 years, as you're aware, we had a little bit challenge in equity performance. That performance has been very good now. The new flows have started. So, and also if you can see over the last 3 quarters, our SIP numbers have started going up. So effectively, there will be a positive lag effect, and a lot of new SIPs which are getting registered. I think that will help us to increase our market share. The present flow that is coming out of SIPs which are registered last 2-3 years, where we did not get a market share. But directionally, I think we are happy. I think the new flows and the new SIPs have been increasing. So that is number one. I think the other question, Pratik, on the NFO.
Yeah. So from the NFO perspective, there are no specific costs related to NFOs. So I could not get your question. So there are no, NFO costs these days, which we have to incur. The only thing one could be that, look, if some spend has been done on the advertisement basis, otherwise there are no specific NFO expenses which were incurred in the previous quarter as compared to this quarter.
Yeah, so my question was around the marketing expenses specific to the NFO, which we have done. So those wouldn't be that material?
So overall, if you see the expense here, as I mentioned to you that, look, this expense line item has been range bound plus or minus 10% here and there. And if you see, of course, there is, previous quarter, we had one large, offering which was there in terms of our FlexiCap fund. So, so there could be some impact of that marketing spend which we have done higher. But, but that is not very significant, to talk about, because the overall spend has not been, changed dramatically. So as against the 42 crore this quarter, this was last year 45 crore.
I think, and your final question on the mix through the IFAs and distributors, that's on slide number 27 of the investor presentation. The detailed breakup is there.
And just to follow up, so against this 42 crores, you said that for the last quarter, this number would look like 45 crores. Is that right?
So Q3 other expenses. See, if you go to the detail of the consolidated numbers, what we have presented. So if you the other expenses which account for 42 crores in Q3 was 45 crore last quarter. YOY. And 49 crore last quarter and 45 crores in Q3 21.
Good. And some color around our fund performance, whether there has been some change in the strategy or how are the earlier strategies panning out for us, some color around that.
So I think it's we have had a new risk framework that we have implemented. So I think leveraging on our research and a new risk framework that has been implemented, working closely with Nippon Life from Japan also. I think a lot of things have been, so it's a proprietary tool from Nippon that we are trying to use. So it has helped us. So it's a both mix of art and science and trying to have a better risk framework. So I think we'll not be able to, go too much into detail for that. But I think ever since it's been implemented, and along with a strong research capability, fund performance has stabilized.
Got it. Thanks for this.
Thank you. The next question is from the line of Akshay Jogani from Exponent Tribe. Please go ahead.
Thank you for the opportunity. I had a little bit of a big picture question. If you kind of take 2 steps back and think about how the industry structure has evolved, would you kind of talk about the power balance between distribution companies and manufacturing, right? How has that changed over the last 5 years according to you all, and where do you see that going? One of the reasons that I asked this question is that you spoke about how the current spike in commissions that the distribution companies are getting is transitory, and from the way I see it may not be, because on the manufacturing side there's just a far more number of companies that are entering, and they seem to have a different positioning, and all will likely be building the same distribution channel, right? So we need to sort of get your thoughts on how it has evolved and where do you see it going.
I think very difficult to answer this question. I think all stakeholders, are jointly working towards the growth of the industry. And your question on power, I do not know what do you mean by power, equation, but I think broadly, I think it is anybody, whether it's a distributor, advisor, MFD, or a manufacturer, everybody has to add value to the investor. And secondly, it will all depend on coming back to the question on manufacturers. It will depend on different manufacturers. What is the strategy? If somebody who's working for a growth and top line could have a very different strategy. I think as we have articulated in past also in my earlier comments, I think we will be focusing broadly. Our focus will remain on profitable growth, and we will not mind walking away from business that does not leave anything on the table.
Sure. Only if I may kind of follow up, sir. What I meant is that if you see the realizations of the asset management companies are sort of getting compressed, right? It is not, the compression is not at the same level among the companies that are actually distributing the products, right? And so that kind of seems to suggest that they seem to be able to price, get a better pricing for what they do. Is that a fair assessment?
I don't think so, because there are not that data may or may not be available. I mean, as transparently, But I think the way I see it, I think we have very clearly, I think, mentioned in past. There can definitely, and Prateek also mentioned, there can definitely be a compression in realization. That could be where the competition, whether it could be what you call distributor power, or whether it could be because of the investor, or could be because of regulator. I think what we have to see is how are we building up our ecosystem to do the same business at a lower cost. How are we building up reach to go deep into Bharat? And I think your question on, I think every manufacturer will go to the same distributor, that necessarily may not be true. It depends basically. I think if you have a long-term vision today, I think we are one of the few non-bank based that asset management companies, the kind of granular reach that we have built up, and we commented on a B30 strategy. So I think it's about building up a granular business. I think working closely with distributor and keeping investor in mind in the center. I think that is the key. I think it is not about sharing or our fees on what we are sharing. I think as long as we keep adding value, all of us keep adding value to the investor. I think we clearly see there's enough juice available for everybody.
Definitely. The second question was on ETF economics. So just technically, if I heard it wrong, I heard that realization at the revenue level was about 9 to 10 basis points. Is that correct?
Sorry?
ETF economics, you said that you make realizations of about 10 basis points. Is that correct?
Yeah, we make net, including the government mandates, we make about 10 basis points. If we remove the government, the CPSC part of it, our realization is about 13 to 14 basis points net of all expenses.
Sure. Okay, so this is the operating earnings realization.
Sorry?
This is the profit realization.
Yes. Besides that, there is just, the employee related cost, the small team, what we have to which runs the ETF. Because see, we have a common distribution team. And we have few employees which are dedicated to ETF, which is on the fund management and the product side, and then of course we have a separate dealer. So those small team, that is a separate cost which for running the ETF. The rest all is same. Sure.
So is it fair to assume that, let's say the 50,000 crore goes to 1 lakh crore, then the whole incremental 12-30% yield will slow down to operating earnings?
Yeah. So entirely, see, whatever expense, see, all our expenses, what we charge to ETF are available. Of that, if you remove the 2 basis point and another 1 or 2 basis point on top of other expenses, then becomes our net yield, and which is directly adding up to our profitability, because obviously we would, if this amount becomes 50 to 1 lakh or 1 lakh to 2 lakh, we would not need, more number of people, so there is no incremental fixed infrastructure or employee cost associated with it.
Great. Thank you so much. This is super helpful.
Since on ETF, I'll also like to add, I think unlike other assets, with the liquid funds and all, because here expense is not more than the expense, the traded volume is more important. Because if the volume is not there, the impact cost leads to negative carry for the investor. So I think, and the fact that we have the highest volumes in the stock exchange actually puts us in a very comfortable position.
Thank you. I'm sorry to interrupt you, Akshay. I'll request you to come back in the question queue. Participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Dipanjan Ghosh from Kotak Mutual Fund. Please go ahead.
Hi, good evening, sir. 2 questions from my side. One is I was looking into your individual equity market share broken up into channels, direct and regular. And it seems that in B30 cities, your market share on equity portion for the individual segment has almost, in the direct channel, has almost declined by 550, 600 basis points, much higher than declining across other channels or overall for the company on the equity side. So just wanted to get some color on that. And on the second question, if you can shed some light on, how the customer journey changes between, let's say, 10 years back when they used to go through the direct, through the broker channel, or even today, versus when they come through some of the newer fintech sort of channels or the direct channel. And does that indicate that performance as a parameter gradually becomes more and more important to track? That's all from my side.
So I'll take the second question first. I think we'll come back to the data. I think the customer, whether it's coming through a conventional distributor, IFA, bank, or a fintech, I think performance has and remains as an important parameter. I think having said that, but performance neither was or neither will be the only sole parameter, because I think that ultimately it's going to be the brand, it's going to be the overall customer service, and also there is a realization today that I think it's performance. I think consistency of performance is more important rather than performance for that 1 year at that point of time. So I think we have seen, as into your question, over the last 10 years, investors, irrespective of which channel they are coming, they're evolving. Investors are deciding which 5-6 funds they want to invest. They pick up the funds, and it is not necessarily based on the fund, only one parameter, that is last 12-month performance, but it's the more consistency of performance along with the brand, service, local servicing, multiple things. And that's exactly the reason, I think, if you see from our perspective, we continue having a very strong a network of 270 branches, 85,000 distributors, and at the same time, keep investing in a digital ecosystem where we are doing almost 58% of our new purchases are coming through that. So I think performance was and remains important, but I think it's a complete ecosystem around it. But the one big change is people like to see consistency in performance rather than just a flash in the pan.
Sure. That's elaborate. Maybe on the first question, your sharp decline in market share for individual equity segment through the direct channel in B30.
Yeah, so see, again, the B30 more has been towards the equity flow, and as I mentioned in the past that in my earlier conversation, that look, we have been lagging in terms of our overall equity sales, which will come with a lag effect, because obviously last 2-3 years have not been so good because of the transition as well as the fund performance. But if you look at the last 6 to 9 months, the performance has come back sharply, and most of our funds are now doing good. And, so the flows will come with a lag effect. So that's how, you'll see that, whatever we have seen the decline over a period of time, we're likely to recover this. But still, I would say that, look, our contribution from B30 locations still remain at 17.5% as compared to 16.6% of the industry.
So just to interrupt, I think I was asking more from the differential between direct and regular in B30. So the market share losses seems to be more profound in the direct channel. So I think that's what I was, kind of trying to understand.
No, again, that is, see, direct is even more profound because of the performance. See, that, look, a guy who's, because there is no, they are looking at a very near-term performances, when they are investing, and especially for last 2 years, if you look at in the COVID, people who have been investing direct are more because of the fact that, where the performance have been, they've been investing into those schemes through various partner websites. And there, our schemes are not featuring. We understand that, but now if you look at most of the partners, RIAs, etc., our performance have been featuring in any of the competition matrices, our schemes are featuring there. So obviously we see that, look, we'll be able to recoup much of the market share loss over there.
I think the way we are seeing the change in trend in overall AUM, I think we are confident. I think over the next few quarters, equity will also market share will be able to regain the market share.
Definitely. Thanks and all the best.
Thank you. The next question is from the line of Abhishek Saraf from Jefferies India. Please go ahead.
Hi, good evening, everybody. Thanks for the opportunity. So several of my questions have been answered, sir. Just a few of them remain. So if you can just help me understand on the NFO part, means how much money did we raise in this quarter in NFOs, if possible, to break out across different launches. And secondly, if I see on the industry NFO traction, so clearly there has been a sharp dip. So 2Q was very high on NFO mobilization, and 3Q kind of came down. So are you expecting or seeing some kind of NFO fatigue which is setting in, or do we still expect that the kind of NFO momentum we have seen across industry that is going to persist for at least next few quarters? So that was on NFO. And also, if you can help me understand, is there any product gap in the core equity offering that we wish to do apart from the ETFs that are lined up? So this is my question, sir. And one more that I'll follow up later. Yeah. Sure. Thanks.
Okay. As far as the NFOs are concerned, as far as the NFOs are concerned, as we mentioned, I think in our presentation, we did one Taiwan fund, which was again a unique product offering. And before this, we had done a flexi cap. I think from our perspective, we do not see any major NFOs coming up from our side. We will continue filling up our product suite by coming out with unique products. And I think a lot of these products that will come, we will not like to go for mega NFOs for two reasons, which I'll try to address after this. But I think the key thing is going to be we'll continue completing our product suite and let the investors and the advisors decide as and when they need. So, for example, in the Q2, we launched our IT ETF, now I think auto ETF, silver fund of fund, electric vehicle fund is coming, Europe fund is coming, I mean, there are a couple of things that we'll keep launching, and our objective will not be to come out with one mega fund. The reason why I say this, I think we clearly believe, I think we do not want too many first, I think, go aggressive in pricing and try to raise a lot of money. I think we believe, like I mentioned earlier, it has to be profitable for us. And I think we'll prefer seeing investors coming over a longer period of time rather than getting, from a risk management point of view, getting 500,000 from investors in 10 days and all these investors ride the same cycle. So I think from our perspective, as a better risk management, we like to see investors coming over a longer period of time rather than just an NFO. So while from the industry point of view, I will not be able to comment too much whether the fatigue is there or not, but from our side, we will not see any mega NFOs. I think we like to go with a steady growth going forward.
Thanks. And also, if you can just touch upon me, how much were we able to raise in this quarter through NFO route?
So, as mentioned by Sandeep, that look, we are in a race of launching too many NFOs. We just did one NFO last quarter, which was the Taiwan fund, and we raised about 620 odd crores. So last quarter was only one NFO, which was Taiwan fund, and prior to that, that quarter we had two funds. One was on the ETF side, and one was the flexi cap fund. So there the previous quarter we raised about 3,800 odd crores. The last quarter we raised about 620 crores. But see, the important point which Sandeep did mention that look, we do not want to grow too much of assets, unless there is a unique product which we want to offer to our investor as an investor first philosophy. It is not that we go for a Me Too kind of a product and launching large NFOs.
Sure. Thanks, Pratik. That's quite helpful. Lastly, on just one bit on the interest rate side. So given that interest rates are expected to go up across the board, what effect do we see for our debt funds? So debt funds had a very good inflows in FY21, but after that, it kind of petered out for the whole sector. And can we expect that this year, what is your outlook for debt fund flows, given that interest rates will be on a rise? And secondly, what that could mean for our other income pool, which has been a bit volatile. So going ahead, means the mark-to-market impact that you also referred to it during the early part of the presentation. So could we kind of be building in that kind of impact further in FY23?
But I'll request Ashwin Dugal, Co-Chief Business Officer, to take the first part, which is our portfolio for the investors. Ashwin.
Thanks, Sandeep. And this is Ashwin here. Just to answer the first part of the question relating to, the likely interest rate scenario which is panning out for the markets. I think our portfolios, as Sandeep and Pratik have mentioned, we have now a full suite of products, both on fixed income and in equity. And as we go along for the next quarter at least, we see most of these flows coming in at the shorter end of the curve. Okay, and that has been the case over the last, I would say about 2 quarters, where the expectation had been that the central bank action, etc., would lead to eventual hike in interest rates and withdrawal of liquidity. Hence, we've already seen over the last 2 quarters the bulk of these flows coming into the liquid and ultra short-term categories. However, there is another segment of funds which is largely roll-down products within that 3 to 5 year bucket, both on ETFs as well as some of the actively managed funds which have been repositioned in that space. So therein we are seeing some money which is coming in purely because it provides the investor visibility of returns for the period that they are invested for. So from that point of view, I would say that we are fairly well positioned to capture any cycle on the fixed income side, and be it at the longer end or at the shorter end, and we have that full suite of products. On the realization thereof, how it could impact, I'd ask Pratik to shed some light.
So I think, obviously we have seen that, in many of our funds, given that how our performance has been and how the portfolio construct has been, we have been marginally improve our, realization. And also we expect that, while there could be, because most of our portfolios was constructed in the recent times and they were at a lower yield, and hence we do not see any compression coming in. But once the net yields for the investor keeps going up, there will be a propensity for us to charge more. So obviously it will be interesting to see from second quarter Q FY23. We may see because right now the debt yields are at one of the lowest. And if it goes up, then probably from our perspective, we will be able to charge slightly higher expenses from third quarter FY23.
Yeah. Thanks a lot, Pratik. Thanks, Ashwin. Thanks, Sandeep. Yeah.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal Financial Service. Please go ahead.
Yeah, thank you for that follow-up again. Firstly, on the fintechs, the kind of scale-up we've seen these fintechs, in terms of distribution. What is the size that Nippon would have these? And secondly, in your non-MF business, what will be the revenue contribution, EBITDA and PAT contribution from the non-MF business?
I think regarding the fintechs, Arpan, our Chief Digital Officer, I'll request him to take this question, and then we'll come back to Pratik.
Thank you, Sandeep. See, on the can you repeat what on the fintechs? What was the exact point on the fintechs, please?
The size of the fintechs has been growing in terms of distribution.
Sure.
So where are we in terms of market share? What kind of tie-ups do we have with these fintechs who are distributing, and further scale-up possibilities on that side?
Sure. Thank you. What we do with the fintechs is, what we have done with the fintechs is where we have been able to give them a complete digital ecosystem where they have been able to integrate with us. I think what really matters in this digital architecture is on how quickly and efficiently can you build a very agile ecosystem which can be permeable as per the various users or journeys that various fintechs might have for their customer journeys. I think Nippon leads in that. We are always the first point of contact for any potential fintech in this country where they would want us to help them handhold in getting into this entire scenario. Once we are into business with them, we have seen that we always feature in the top 5 of being able to attract investors. And that has been because of our exciting digital chassis, and of course our product performance and other factors which my colleagues were talking about. Yes, on the fintech piece, Nippon is probably one of the top picks for any existing and new fintech who wants to get into the mutual fund space.
Okay. And any you want to quote out there as to what kind of size is the fintech industry, and what would be the market share of Nippon there?
If you look at the fintech industry right now, the entire AUM is 1% of the overall industry AUM. So on the AUM piece, it is negligible, but what it is doing is it is opening up the market and helping a lot of millennial customers coming into the mutual fund industry fold, which itself is very, very welcome. As I said, on our share piece, we are on the top 5 across any fintechs in this country.
So just to add to it, if you were to look at it, a lot of fintechs, like in mutual fund right now, still fintechs have been small. But I think you've seen, especially in the broking side, fintechs have done a great job. I think they've been able to get a lot of new investors, new demat accounts. If now you were to marry that with the increase in our own ETF investors, that tells you the story. So I think we have a well-integrated API ecosystem, I think integrated with majority of the fintechs, which is not only related to the ones into wealth management and mutual fund, but also into the Indian capital markets. So I would attribute a lot of increase in our investor base, which has happened in the last 18 months in ETF due to the fintech integration.
And on my second question on the non-mutual fund revenue, EBITDA and PAT contribution.
Yeah, so we make almost about 100 odd crores, on the non-mutual fund businesses, and almost 50% would be the net profit on that.
Okay, great. And lastly, just slipping in one more, what is the plans of utilization of the cash? Any further developments that you can talk about?
I think we continue exploring options, both as I mentioned in my earlier address, organic and inorganic opportunities. That is number 1. But I think for us, the key thing is that it should be accretive to the shareholders, number A. I think, and we are not only talking of acquisition of another management company or something. I think we remain open to invest into companies which can help us increase our ROE in our entire operations. See, if you were to look at it, we are doing almost 50 million in transactions, per annum. There are a lot of things, where I think we see opportunities of investing which can help us increase our ROE. So whether it's asset management company or anything else, any other company which can help us increase our ROE, that is our approach. And I think we continue to keep evaluating, and whenever there's something concrete, I think one of the calls will come and share with you.
Sure. Thank you so much, and all the best.
Thank you.
Thank you very much. As there are no further questions, I will now hand the conference over to Mr. Samir Vise for closing comments.
Thank you everyone for joining this call today, and thank you to the team of Nippon Life India Asset Management for giving us this opportunity to host the call. Thank you and goodbye.
Thank you very much. On behalf of JM Financial, that concludes this conference. Thank you for joining us. You may now disconnect your lines.